Banks lure us to deposit our hard-earned money with tempting promises. Let your money work for you. Watch your deposits grow. But what if I told you it's all a lie? A bad idea. A grand illusion masking the slow destruction of your family's financial future. You see, the balance representing your savings dollars may increase each month, but its actual purchasing power is steadily declining. Rising inflation ravages the real value of cash, left sitting in low-interest accounts. What bankers won't tell you is that everyone depositing savings today unknowingly funds risky bank investments, while our politicians and central bankers collude to obstruct and dilute the fruits of our labor. Runaway spending obliges officials to print more currency, which devalues existing money stockpiled by savers like us. It's a silent assassin few even notice bleeding them dry. By now, you may be wondering, if stuffing cash under the mattress ensures we stay poor, what's the alternative? Abandon savings altogether and join the debt party? Squander it on liabilities like flashy cars and exotic vacations? While bankers tempt the masses down this slippery slope, we'll reveal 6 assets proven to defend and grow wealth against corrosive inflation. Not just for your lifetime, but for generations to come. The time has come to secure your family's future on your terms, without succumbing to the grand financial illusion. Here, we have 6 other options. Number 1. Precious metals. Gold, silver, platinum, and other precious metals earn their name for good reason. Their natural scarcity makes them reliable, enduring stores of monetary value. While governments can freely print more paper currency at will, the quantity of natural metals on the earth is finite. This explains why they have served as trusted forms of money for thousands of years. The US dollar was redeemable for a set amount of gold until 1971, when President Nixon abolished the gold standard. He did this to print more money for government spending without the discipline imposed by gold reserves. Today, the Federal Reserve continues this irresponsible tradition, rapidly expanding the money supply, which devalues the savings of responsible Americans. When we understand this monetary reality, gold and silver become especially attractive alternatives for conscientious savers seeking to preserve their wealth. Let's look at the performance history of gold and why experts forecast much higher valuations in the years ahead. In 1970, an ounce of gold cost about $35. By January 1980, it reached a nominal peak just shy of $900 per ounce. Then it declined for most of the next 20 years, bottoming below $250 around 2001. But after that, the Fed's money creation proclivities turbocharged a powerful, ongoing gold bull market. This past March, the yellow metal nearly touched $2,100. Based on fundamental monetary drivers, several respected analysts have set future price targets between $5,000 and $15,000 per ounce, possibly within 5 to 10 years. If achieved, this represents up to a 700% gain from current levels. Such returns would certainly offset the erosional effects of inflation and taxes faced by conventional bank deposits. Gold-focused exchange-traded funds, or ETFs, offer individual investors an affordable and convenient means to hold the yellow metal in paper form. These innovative instruments track the value of gold while providing the added benefits of liquidity and diversification. If you're a working-class citizen looking to follow the advice on investing in precious metals, particularly gold, silver, and platinum, here are some tips tailored to your situation. Start small and gradually accumulate. Given the limited financial resources of a working-class individual, start by allocating a small portion of your savings towards precious metals. Consistency is key, so aim to invest a fixed amount regularly, even if it's a modest sum. Educate yourself. Take the time to educate yourself about the precious metals market, especially gold and silver. Understand the factors that influence their prices and the historical trends. This knowledge will help you make informed decisions. Set a precious metals budget. Allocate a specific portion of your monthly budget for precious metals. Even a modest amount can accumulate over time, contributing to your overall financial security. Consider fractional ownership. Precious metals are often priced per ounce, which may be beyond the reach of a working-class budget. Consider fractional ownership, buying smaller increments of metals, making it more accessible for regular investments. Utilize gold-silver ETFs. Opt for gold-focused exchange-traded funds, ETFs. as they provide an affordable and convenient way to invest in precious metals without the need for physical storage. ETFs also offer liquidity, making it easier to buy and sell. Leverage dollar cost averaging. Implement a dollar cost averaging strategy, investing a fixed amount regularly, regardless of the current price. This approach helps smooth out market volatility and allows you to accumulate more metals when prices are lower. Educate yourself on storage options. If you decide to own physical metals, research cost-effective and secure storage options. Some dealers offer storage services for a fee, which might be more practical than storing precious metals at home, especially for smaller investors. Industrial commodities. While precious metals serve primarily as monetary safe havens, certain industrial commodities also protect against inflation due to intrinsic utility value derived from their physical characteristics and applications. Silver again makes for an ideal example. In addition to its monetary merits, silver boasts antimicrobial properties, which contribute to its use in medicine and healthcare. Solar panels, consumer electronics, batteries, and nuclear reactors also depend on abundant silver supplies to function properly. Rapidly rising demand against potentially constrained future production has supported a bull market in copper as well. Nicknamed Dr. Copper, this base metal acts as a barometer for industrial and construction markets due to its diverse applications. Electric vehicles use twice as much copper as conventional cars, with some estimates pointing to a supply deficit by 2024. Copper set a new record high this past spring. However, cobalt perhaps demonstrates the inflation protection potential of industrial commodities best of all. This somewhat obscure metal is a crucial ingredient in lithium-ion batteries powering electronic devices and electric vehicles. Between 2016 and late 2021, the price of cobalt increased nearly six-fold in US dollar terms, from around $13 to almost $80 per pound. After pulling back over the last year, expect renewed upward momentum. Rather than storing barrels of copper or cobalt in the garage, investors can gain a well-diversified exposure to a basket of industrial commodities through mutual funds and ETFs targeting miners, equipment manufacturers, or even commodity futures markets. Hard currency. In a world dominated by fiat money devoid of tangible backing, the relative strength and stability of a nation's economy support its currency's purchasing power. This dynamic explains the safe haven status of currencies like the Swiss franc and Japanese yen during times of global financial stress. When Europe descended into a sovereign debt crisis in 2011 and 2012, flows into Switzerland, viewed as a paragon of safety, sent the franc to all-time highs against the battered euro and US dollar. And again today, as negative interest rates devour savings across Europe, the franc stands tall with benchmark rates still in positive territory. In fact, with cash deposits charged with negative yields now representing 25% of the global total, rising Swiss currency values effectively pay savers to hold francs. This leads billionaire investor Ray Dalio to call it the best currency to save in. And if Russian sanctions have taught us anything, it's to expect the unexpected when it comes to currency movements and global trade flows. While currency plays tend to be volatile and not ideal for all investors, including some international currency exposure can diversify savings from the erosive effects of the US dollar's lagging purchasing power. In addition to opening a foreign bank account, accessible options for US residents include forex brokers and currency-focused ETFs and mutual funds. If you're a newbie and interested in investing in hard currencies to diversify your savings, here are some tips. Understand the risks. Currency markets can be highly volatile and are influenced by a variety of factors, including economic conditions, geopolitical events, and central bank policies. Before investing, make sure you fully understand the risks involved in currency trading. Start small. If you're new to currency investing, start with a small amount that you can afford to risk. This allows you to gain experience and learn how currency markets work without exposing yourself to significant financial risk. Diversify currency holdings. Consider diversifying your currency holdings to mitigate risk. Instead of putting all your funds into one currency, spread your investments across different hard currencies. This strategy helps protect your savings from the impact of adverse currency movements. Research strong economies. Focus on currencies from countries with strong and stable economies. Look for nations with low inflation rates, positive GDP growth, and sound fiscal policies. The Swiss franc and Japanese yen, as mentioned, are historically considered safe haven currencies. Stay informed about global events. Keep yourself informed about global economic and political events. Changes in geopolitical situations or economic policies can have a significant impact on currency values. Regularly follow financial news and updates to make informed investment decisions. Consider currency ETFs and mutual funds. For working-class citizens looking for a more accessible way to invest in hard currencies, consider currency-focused exchange-traded funds, ETFs, and mutual funds. These funds allow you to gain exposure to a basket of currencies without the need for direct currency trading. Explore Forex brokers. If you have an interest in actively trading currencies, explore reputable Forex brokers. These platforms provide tools and resources for currency trading. However, keep in mind that Forex trading requires a good understanding of the market and careful risk management. Government debt. Although no national currencies today possess an explicit backing for precious metals, they still carry an implicit backing by the full faith and credit of their issuing government. This means that government debt like U.S. Treasury bonds represents a sovereign guarantee rather than a promise from a private corporation or local municipality. So, while companies and cities occasionally default during periods of economic stress, direct defaults by major nations are far less probable. Therefore, Treasury securities preserve capital even during stock bear markets or financial crises that wipe out more speculative corporate debt and real estate investments. And with Treasury yields vastly exceeding savings accounts or certificates of deposit, they offer a means to earn extra income without risking principal. A prudent strategy for conservative savers and retirees. A quick example illustrates the protective powers of Uncle Sam's stewardship relative to bank accounts. Over the past 5 years, a 2-year Treasury note purchased in late 2017 would have earned over 7% in total return by late 2022, thanks to interest payments and some price appreciation as yields declined. In contrast, the national average savings account rate currently sits below 1%, not even exceeding inflation. The modest income from this FDIC-insured account has less spending value now than 5 years ago, even before considering taxes and fees withdrawn. While Treasury notes and bonds shielded wealth over this time frame, their upside remains limited. So, growth-minded investors may want to diversify into select stocks with inflation-resistant qualities. Inflation-resistant equities, rising prices, shrinking profits, and uncertain outlooks have made investing in stocks more challenging lately. However, not all companies suffer equally in inflationary times. Energy shares offer an obvious example. As input costs and scarcity concerns have driven fossil fuel prices dramatically higher, big oil corporations book record profits. Integrated giants like Exxon and Chevron now pump cash to shareholders through big dividends. These payouts provide defense against inflation, whether reinvested or spent on rising living expenses. The appeal of reliable dividends extends into other sectors as well. Utilities operate monopolies selling essential electricity, gas, and water to customers with little choice but to pay up. Rate hikes support generous and generally rising dividends over time. Consumer staples like beverage makers and food producers also hold up better than discretionary names during periods of economic weakness and uncertainty. While sky-high inflation forces households to cut back on luxuries, we keep spending on necessities like groceries and household products. Beyond strong operations and dividends, most of the companies discussed operate real assets, including pipelines, power plants, mineral reserves, and railroad tracks that hold value better than concepts or intellectual property as the tide goes out. A diversified basket of such equities can lend critical balance to an inflation-conscious portfolio. Reasonably priced mutual funds and ETFs provide convenient exposure for smaller investors. Hard real estate. Similar to dividend stocks, private real estate markets provide exposure to tangible assets plus contracted rising income streams. However, unlevered residential and commercial property delivers superior inflation protection and appreciation over the long run. Consider that despite periodic corrections, the Case-Shiller National Home Price Index has returned an average of nearly 6% annually since 1987. Rental income from tenant leases often tracks or exceeds inflation as well. So not only does real estate act as a supply-constrained hard asset, but owners earn reliable cash flows, shielding them from rising expenses. While primary home ownership makes sense for many, Rental property diversifies geographic and tenant risk for investors building a larger portfolio. Those unable or unwilling to take on the active headaches of being a landlord can now easily invest in real estate through public vehicles, including REITs and crowdfunding platforms. So whether you seek to construct a single or multi-family rental property, farm cash-flowing commercial buildings, or deploy in specialized trusts, hard real estate deserves priority placement in a long-term inflation-fighting portfolio. Collectibles art, precious metals, antiques, and other collectibles grab headlines when they are sold for jaw-dropping sums at Christie's auctions or private sales. But does this space make sense for regular investors? In an inflationary environment where cash burns a hole in our pockets while bonds, savings accounts, and CDs fail to keep pace with rising prices, hard assets definitely hold more appeal. Assets perceived as rare or scarce, like a Picasso painting or 19th century baseball card, can provide especially powerful inflation protection and tremendous financial upside. That said, collectible investing poses large risks distinct from traditional markets. Extreme fragmentation means no standard valuations exist, making it easier to overpay for counterfeits or works from lesser artists. Storage and insurance expenses also add up quickly, eating into returns. But the biggest drawback of collectibles lies in their extreme illiquidity. At any given moment, a few buyers may exist for your prized possessions. And if you ultimately find an interested party, they hold maximum negotiating leverage to drive prices down. While the most prominent collectors win headlines for their trophies, more accessible collectibles like rare coins, musical instruments, and jewelry may suit those with slightly more modest means. Prospective investors should focus intently on authenticity, provenance, demand dynamics, and potential exit strategies before acquiring anything. Inflation steadily erodes the wealth of responsible savers as the government prints money to service exploding debts. Rather than succumb to this plight, you must take action now by accumulating shares in precious metal and industrial commodity producers to profit from scarcity trends, complementing ineffective savings accounts with hard currencies and treasury bonds. Investing in wide moat companies paying reliable, rising dividends, developing rental properties, or investing in institutional real estate funds. Considering passion assets like collectibles on a limited basis. Implementing even a few of these strategies will help position your financial plan as a powerful inflation hedge and wealth-building generator for generations. The time for action is now. Acknowledge the grave danger inflation poses and take bold steps to secure your family's financial future before it's too late. Delay no longer and shield your hard-earned money from rapid erosion. The clock is ticking and your window of opportunity will not remain open indefinitely.